Why capital is pausing at the permitting stage. In 2026, capital is not withdrawing from energy, infrastructure, or industrial development. It is stalling earlier in the investment cycle, often at the permitting stage, because regulatory and compliance uncertainty has become a core determinant of project viability. This shift is reshaping how companies allocate capital, how boards evaluate risk, and how long it takes for projects to move from concept to construction. What has changed is not investor appetite or policy ambition. It is the predictability of the permitting and compliance environment itself. Permitting has become a moving target. Historically, permitting was treated as a discrete phase, a defined set of environmental reviews, agency approvals, and public comment periods that could be scheduled, costed, and managed. In 2026, that model no longer reflects reality. Even after the Supreme Court's November 2025 decision narrowing certain federal environmental review obligations under NEPA, environmental review scopes in practice continue to expand as agencies and developers seek to insulate approvals from litigation. Data requirements are evolving mid-process, and permitting decisions are increasingly shaped by downstream legal risk. As a result, even when approvals are granted, the timing and conditions attached to them are becoming harder to forecast. Research from McKinsey & Company has found that infrastructure and energy projects now face materially longer development timelines than a decade ago, with permitting and regulatory review among the largest sources of delay. In a 2025 analysis of capital project performance, McKinsey noted that regulatory uncertainty directly weakens internal rate of return (IRR) assumptions by extending time to revenue and increasing contingency costs. For capital committees, this creates a fundamental challenge. Returns may still pencil on paper, but the path to realizing them has become less reliable. Compliance uncertainty is now a financial variable. The pause in capital deployment is not driven by enforcement actions after projects are built. It is happening before final investment decisions, as companies reassess whether regulatory assumptions made early in project planning will still hold years later. According to Deloitte, regulatory and permitting risk is now one of the top non-market factors influencing capital allocation decisions in energy and infrastructure sectors. Deloitte's 2025 Infrastructure Outlook highlights that uncertainty around environmental review scope, reporting obligations, and potential legal challenges is increasingly treated as a balance sheet risk, not a compliance footnote. This uncertainty affects capital in several ways. Longer permitting timelines raise financing costs. Expanded review requirements increase upfront capital expenditures. Unclear approval conditions undermine board confidence in execution. In response, many organizations are delaying final commitments until permitting risk is better understood or redirecting capital entirely. Capital is flowing to predictability, not just return. The result is not a freeze, but a reordering of investment priorities. Capital is increasingly favoring brownfield upgrades over greenfield development, incremental or modular projects that reduce exposure to extended review, phased investments that allow reassessment as regulatory conditions evolve, jurisdictions with clearer permitting pathways and fewer overlapping authorities. Analysis from IEA has shown that while global investment in clean energy continues to grow, project timelines in many advanced economies are lengthening due to permitting and siting challenges. The IEA has warned that without faster and more predictable approval processes, capital deployment will increasingly lag behind policy targets, even when financing is available. This dynamic is especially visible in sectors such as grid infrastructure, LNG export facilities, renewable generation, and large-scale manufacturing, where projects often require approvals from multiple federal, state, and local entities. Permitting risk is reshaping competitive advantage. As capital pauses at the permitting stage, organizational capacity is becoming a differentiator. Large firms with deep regulatory expertise, in-house legal teams, and experience navigating multi-year approval processes are better positioned to absorb uncertainty. Smaller developers, new market entrants, and first-time sponsors face higher relative risk, making it harder to secure financing even for technically sound projects. This shift has broader market implications. When only a subset of players can tolerate prolonged regulatory uncertainty, competition narrows and innovation can slow, not because technology or demand is lacking, but because compliance capacity becomes a gating factor. The World Economic Forum, (WEF), has identified regulatory complexity and permitting delays as emerging barriers to infrastructure investment, particularly in energy transition projects that require rapid deployment to meet climate and resilience goals. The strategic consequences for 2026 planning. For executives planning capital deployment in 2026, the lesson is not to avoid regulated projects. It is to treat permitting and compliance uncertainty as front-end strategic inputs, not downstream execution risks. This means stress testing regulatory assumptions early in capital planning, incorporating multiple permitting scenarios into financial models, engaging compliance, legal, and sustainability teams before capital is committed. Prioritizing projects with clearer approval pathways, even at lower headline returns. The pause at the permitting stage is not ideological, it is structural. Uncertainty itself now carries a cost, and that cost is increasingly decisive. In today's environment, certainty has become a competitive asset, and capital is waiting for it. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.